Natural gas futures closed Friday with modest gains, though the advance stalled at resistance around $3.25 on the weekly chart. The next move hinges on whether bulls can push through this barrier or if short sellers reassert control. Storage remains a key obstacle. The EIA reported a 75 billion cubic feet injection for the week ending September 19, broadly in line with expectations, leaving inventory 6.1% above the 5-year average. U.S. stocks are now up 0.5% year-on-year and 83% full, while Europe's storage sits at 82%. Together, these figures highlight that supply cushions remain firmly in place heading into early October. Moreover, natural gas inventories are now projected to close the 2024 injection season at 3,992 billion cubic feet, which would leave stocks running 181 billion cubic feet above the 5-year average. If realized, this outcome would represent the most bearish season-ending storage level in the past 5 years, underscoring the persistence of supply overhang despite bouts of weather-driven demand. In fact, it would also rank as the third most bearish end-of-season mark across the entire 30-year history of EIA records. Such a surplus heading into winter would likely weigh heavily on sentiment, as it signals that the market is entering the peak demand season with one of the strongest storage cushions on record. Nevertheless, prices remain elevated, thanks to lofty expectations of surging winter demand and ever-growing LNG exports. Of course, my experience suggests that when everyone, analysts included, is confidently calling for higher prices, that's usually the perfect setup for the market to do the exact opposite. After all, they don't call natural gas the widowmaker for nothing. Winter weather will ultimately hold the reins, and even a modest shift toward the warmer side could pile on bearish pressure. Throw in any hiccup or slowdown in LNG exports, and suddenly that surefire rally could morph into a sharp price crash, or at the very least, another bout of wild volatility. Meanwhile, forecasts call for warmer than normal U.S. temperatures through October 10, curbing early season heating demand. On the supply front, production remains near record levels. Lower 48 output was 107.7 billion cubic feet per day on Friday, up 6.8% from a year ago. The EIA recently raised its 2025 production outlook to 106.6 billion cubic feet per day, while Baker Hughes counted 117 active rigs, just shy of the 2-year peak seen in August. Together, these figures underscore the bearish weight of abundant supply. Natural gas futures remain caught in a tug-of-war between conflicting forces. On one side, oversupply and persistently mild weather forecasts continue to pressure the market, while on the other, power generation demand offers some degree of support. Price action is stuck in consolidation, with $3.25 emerging as the near-term pivot. A decisive breakout above this threshold could spark short covering and open the door for a run toward $3.35 or higher. Yet the weight of strong storage levels, record-setting production, and limited heating demand keeps downside risks firmly in play. Without a convincing push through resistance, the bias tilts bearish, with traders setting their sights on the $3 support zone as the next potential target. Don't forget to drop a comment, check out the last video and support the channel. Catch you in the next one.